There's this common saying in trading: the market is always right. At first glance, it might seem confusing, like, what the heck does that even mean? But once you truly understand it, it can completely change the way you trade and help you make a lot more money. First, let's talk about something we already know. Most traders lose money, right? And it's not because they pick bad trades or use bad strategies. It's actually because they don't fully understand risk and reward. Let me explain. Risk-reward, simply put, is just this: how much are you willing to risk to earn a certain reward? For example, if you buy an option for $100 and your take profit is $300, your risk-reward ratio is 1 to 3. That means even if you only win 30 or 40% of your trades, you can still be profitable. Now, here's where things get interesting. Say Trader A has a 70% win rate, but risks $500 to make $100 per winning trade. And then we have Trader B, who only wins 40% of the time, but risks $100 to make $300 per winning trade. Who's going to be more profitable over time? Well, it's actually going to be Trader B, even though Trader A is winning 70% of the time. Why? Because Trader B has a much better risk-reward ratio and that lower emotional pressure. So, why is this important? Because it shows us that the most important thing is not having the highest win rate. It's about having a good risk-reward ratio and being consistent. Plus, let's be honest, trading is hard enough as it is. Why make it harder by taking trades that aren't set up very well? But there's another part to this that a lot of people don't realize. When you're trading, you should never enter a trade unless you know two things. Know, 1, how much you're risking, and number 2, what your take profit is going to be. Anytime you place a trade, ask yourself, how much am I risking and what do I stand to gain? Make sure your risk-reward ratio is at least 1 to 2 or better. That way, even if you lose half your trades, you're still winning overall. And here's a little bonus tip. If you want to be really good at trading, try to stick to a 1 to 2 risk-reward ratio. When you do this, you'll be able to find the best trades and avoid the ones that aren't worth it. Okay, so now let's go a little deeper. What does the market is always right mean exactly? Well, it basically means that the market will always move in the direction that makes the most sense based on supply and demand. Let's say you're trading stocks and you see a stock price suddenly shoot up. In this situation, it usually means that more people want to buy the stock than sell it. In other words, there's more demand than supply. That's how we got the term bull market. It's when prices are going up. On the flip side, if you see a stock price suddenly drop a lot, that usually means the opposite. There's more people wanting to sell than buy, more supply than demand. So the market is telling us that this stock is in high demand, and the price will probably keep dropping. We call this a bear market. It's when prices are falling. So what does this mean for you as a trader? It means that instead of trying to fight the market or predict what's going to happen, you should focus on understanding the basic principles of supply and demand and use that to guide your trading decisions. Now, I know this might be a bit confusing at first, but trust me, once you get it, it will change the way you trade forever. Just remember, trading is not about being right all the time. It's about managing your risk, being consistent, and letting the math work for you. If you've got some value from this video, hit like and leave a comment below with your best risk-reward ratio and subscribe for more videos just like this one. Thanks for watching, and I'll see you in the next video.